We are very pleased to gather you all to address this topic of retail social investment. So to let you know where our participants speak from, I'm just telling you that I'm here in Brussels at EVPA's office. Camilla is with us from London, Pierre is in Paris, and I think Marco is in Milan, unless it's in Torino, but he will confirm with us. So let me already...
No, I'm in Milan.
So you're in Milan, great. So let me all thank you again for your availability and implication in the preparation of this session. Looking at this slide, we have the program. So it's as follows. So Camilla will start by explaining some key trends of international retail social investment, while also highlighting the key findings of a report she wrote together with her colleague Simon Rowell, and which was published by Big Society Capital in March this year. Pierre will then depict the more specific French situation of retail social investment, focusing its intervention on the very interesting employee savings scheme known as the 90-10 Solidarity Funds. After that, Marco will give us a concrete example of retail social investment in Italy, highlighting the key characteristics of Terzo Valore, a crowdfunding platform offering local social investment opportunities. We'll then come back to Camilla, who will give us a specific overview of retail social investment in the UK. As already mentioned, at the end of this webinar, we'll have an interactive panel discussion and a Q&A session. So that's going to be after the presentations of our three speakers. We invite you all to ask any question you might have in written form throughout this webinar, clearly mentioning to whom you are addressing your question. And we'll do our best to direct those to our speakers at the end. So without further delay, I'm leaving here the floor to Camilla Park from Big Society Capital. Thank you again for being with us today, and we all listen to you. Thanks.
Thank you, Eleanor. I think it's fantastic that the EVPA has brought us all together around this topic of how we can engage more ordinary people in what will hopefully become a very participatory and diverse social investment market. And I think there's a real sense of momentum here, and certainly at Big Society Capital, this is one area that we are focusing a lot on. And it's great to be able to sort of share our perspective and to learn from others. And hopefully this will be just the start of a conversation that we can carry on post this webinar. So I would absolutely say, please do sort of approach us at Big Society Capital and come back to us around conversations about how we can together sort of grow the retail social investment market going forward. Next slide, please. Okay, so before we dive in, I think, to some of the different types of models that we see in the UK and more broadly across Europe, I just wanted to touch on why we think this is important. Why do we want to see a more diverse, inclusive social investment market? And this image you can see on the slide is of residents who live in accommodation that's provided by an organisation called Golden Lane Housing. And they're part of MenCamp, which is a UK charity that provides support for people with a learning disability. Now, back in 2013, so around 3 years ago, this organisation, Golden Lane Housing, worked with Triodos Bank, a social bank, to structure and issue a product called an unlisted charity bond, which is essentially a sort of fixed income type products, and it was specifically structured to be accessible not only to institutional investors but also to retail investors, and it proved to be hugely successful. I believe they raised over £10 million in under 2 weeks, and the issue was oversubscribed. And actually the organisation Golden Lane Housing used the investment that was provided by retail investors to buy more houses, to support more individuals and to grow their impact. And I think this is a fantastic example of the type of impact that we can create if we have a more diverse and inclusive market that consists of not only institutional investors, foundations, but also individuals. And I think it's important to say that actually ordinary people can bring something very different to the market. And our hypothesis is actually for charities and social enterprises looking to raise finance, could ordinary people provide a different type of capital that actually you can't get from other types of investors? Perhaps a more patient type of capital, perhaps more longer term, and I think certainly in the UK there's evidence to suggest that that's actually a gap in terms of the provision of finance. So we certainly see that retail investors and ordinary people could play a greater role in this. And actually, just finally, I think it's important to say that investment is not often just about the money. And actually, if we can grow this sort of market and connect more individuals with causes that they care about and allow them to use their money to support the mission of organizations that they believe in, you know, we could create sort of deeper relationships between those organizations and individuals. So I think, just to summarize, greater participation we think is really important, not just from the perspective of individuals as investors, but also from the perspective of organizations that are looking to raise finance. Next slide, please. So just to sort of summarize, as I said, Big Science Capital is actively looking at ways of growing the retail social investment landscape. And one of the approaches that we took when we were thinking about this is to, first of all, take a look internationally at what's happening across Europe and across the world, and to see where other models are catalyzing this type of investment. So my colleague Simon and I produced a paper, that you can see the link at the bottom of this slide, that looks across some of these models, and I would urge you to take a look at it, because it covers them in a lot more detail than we can do here. But just broadly, the interesting thing I think was the diversity in approaches. And as Eleanor mentioned earlier, I think it is important to say that all of these models have sort of risen up in pretty diverse cultural contexts, regulatory contexts, with different degrees of government intervention and so on. But I think there are still some really interesting insights that we can pull out from across these models and learn from each other about how we can catalyze this in our own markets. So briefly, what we did is looked in depth at how these different models are engaging a broad spectrum of investors, and we plotted them very sort of loosely on a spectrum, and you can see the diversity of the models that we have here. So on the left-hand side, we have this very local sort of community investment type model from Denmark, and this is a really great example of the role that government has played in actually mandating community investment and community involvement. And this is in the context of community sort of renewable infrastructure, so wind turbines. The government actually passed legislation here that required commercial developers to make a portion of community ownership available to local people who are living in the surrounding area. Then we move through to models that are focused more on engaging ordinary people around specific causes or to finance specific projects. I know Marco is going to talk us through the Italian example in a lot more detail, but the other case study we picked up on is in the Netherlands in the Green Fund scheme, and this is a way in which the government worked with financial institutions to channel ordinary people's investment capital into specific environmental projects, and that happened both on small-scale projects right the way through to larger infrastructure, so channeling larger portions of investment through there. And then as we move along, we see examples like the community investment note that was launched by Calvert Foundation actually a number of years ago, I believe in around 1995. And this is, again, another sort of fixed income type product that allows individuals to invest into pooled or themed funds, either around specific topics, so supporting healthier aging, for example, or around sort of geographical areas of interest, but it's really aggregating investment opportunities and allowing individuals to invest in an indirect way through a specific targeted product. And then right at the other end of the spectrum, we see more than 1 million people in France who are engaging in this broader solidarity finance landscape. And again, we see in this model a huge variety of different ways in which ordinary people can invest through sort of savings products, solidarity investment products, and also the probably most well-known example is the 90/10 funds that I know Pierre's going to talk about in a little bit more detail. So just I think at a high level, what this sort of scanning exercise showed us is there's really no one defined path or one journey, as different social investment markets are evolving in very different contexts. But certainly there are elements that we can draw from these models to learn about how we can catalyze this in the future. Next slide, please. So just thinking across some of those different models, there are just three things that I think are interesting to pull out and to highlight across a number of these. The first is actually the role that institutions and intermediaries are still playing in connecting ordinary people and investors to different types of investment opportunities. So as I said in the example of the Netherlands with the Green Fund scheme, I believe the government worked extremely closely with the finance sector in the Netherlands, with the Dutch Bankers Association and others, to co-develop specific products that could channel investment into environmental projects, and then they work together to find ways, the best way of distributing that to the largest pool of investors. So I think that connection point and the role that intermediaries can play is still important. The other thing I think that's interesting across a number of these different models is thinking about the staging at which retail investors can come in or perhaps invest in partnership with others. And a couple of the examples sort of demonstrate the role that individual investors can play, perhaps if they come in after an institutional investor or before an institutional investor. So I think the staging and the timing at which you can bring in ordinary people in combination with other partners is a really interesting dimension. And just finally, Eleanor mentioned the previous webinar that looked at crowdfunding and the sort of growth of peer-to-peer platforms. I think what we're seeing here is a real explosion in terms of the way in which we can connect people to causes that they care about. And certainly the Calvert Foundation with the Community Investment Note, they were pretty pioneering when they used an online platform to, first of all, lower the cost of investing, which meant that people could invest, I think, for as little as $20 into that note product. But actually they also used the platform as a way of communicating the impact of investments. So I think, as we sort of acknowledge, crowdfunding and peer-to-peer networks is going to create a huge opportunity for the way in which we connect people with opportunities and how we talk about impact in the future. So with that, I will just pause, but also I'd like to just say that if there are other organisations out there or other models that people are aware of that we haven't picked up on, please do get in touch, because we're always keen to hear about what others are doing and build that sort of knowledge base of retail models. Thank you.
Thank you, Camilla. I think, yeah, we will definitely come back to these questions also in the panel discussions at the end. It's giving us a very good introduction to this mechanism to just attract and allow to everyone, you know, to be part of this social impact investing movement. So thank you very much for that. After this more general introduction, we will turn to the French case of retail social investment. So I leave the floor here to Pierre Valentin, who is working at Ecofin Investissement. Pierre will give us an overview of what's going on in France and focusing also on these 90/10 solidarity funds that are really capturing a big chunk of employee savings in order to support what is called in France économie sociale et solidaire. So I will leave you the floor here, Pierre, and thank you again for your implication here. Can you hear me?
Yes, yes.
Yeah, perfect.
Can you hear me?
Now we can hear you.
So
Yeah, perfect, thanks.
Next slide, please. Yes, next slide again, please. Thank you. So before explaining the 90/10 fund, I will remind how works employee savings schemes in France. They were created in 1967, so it's a very old scheme, and the idea at the time was to share part of the profit of the companies with employees. So basically 5% of the profits are shared with the employees by law above a certain hurdle. So there is a hurdle, and if you are above the hurdle, you have to basically to share the profit of the company with your employees, 5% of the profits being given to the employees. So what is the advantage of this very popular system? It's a tax-free system for the employees. So they don't pay any tax on this revenue, and they don't pay taxes on the interest or the capital gain on the scheme. Basically, the employee has to choose what type of fund he wants to select in order to place the money he receives. He has a choice between three funds. Usually these funds are bond funds or equity funds or money market funds or even funds invested in the shares of the company itself. So there is a competition in the choice. So this system has existed for 50 years approximately, and it changed in 2001 because at the time there was the creation of the 90/10 funds called in French Fonds Solidaires. The government decided to compel the companies to offer in the choice at least one 90/10 fund. So there is no obligation for the employee to invest in this type of funds because there is always a choice between a number of funds, but there has to be at least one Fonds Solidaires. What is a Fonds Solidaires, or called 90/10 by most of the people? It's a fund where 90% at least of the net asset value is managed according to classical asset management techniques, for instance bonds or equity, listed bonds, listed equities, at least liquid assets, and 10%, more precisely, not more than 10%, but not less than 5% of the fund is invested in social businesses. Social businesses being defined very precisely by the law, but this is not the issue today to describe exactly how a social business is defined by the law, by the French law. So let's keep in mind that typically between 5 and 10% of the fund is invested in social businesses. Invested means a loan or equity or a security, a financial security. So this was, of course, a great idea because it didn't cost anything to the government because all the employee savings scheme is tax-free. So you only have to include this compulsory offer of a Fonds Solidaires within the choice for the employee. So it was created in 2001. And from 2001 to 2010, it was restricted to some categories of employee savings schemes, not all the employee savings schemes. But since 2010, all employee savings schemes have to offer these 90/10 funds. And all employee savings schemes, what does it mean? It means approximately 100 billion euros. So if we go to the next slide, thank you. We can see the spectacular increase in the assets under management of 90/10 funds since 2010. So now we have 4,933 million of euros at the end of 2014 of 90/10 funds. And if you look more precisely, you see that most of these assets under management come from employee savings scheme. You have two colors, and you see that the the clearest color is for funds that are subscribed outside of employee savings scheme. And the other color is for the funds that are subscribed within the employee savings scheme. It's interesting to note that you can subscribe such funds outside of the employee savings scheme, and there is an increase of the outstanding in this category, but of course not so spectacular as the employee savings scheme. Of course, if you want to offer funds that are outside of the employee savings scheme, you have to comply with regulation for the offer, the public offer of financial securities, which allows you, anybody in Europe can create a fund with less than 10% of non-listed assets. There have to be securities, but you can offer to the public a fund with 10%, maximum 10% of not listed assets and 90% of listed assets. So it's a reason why the development of Fonds Solidaires in France is not only based on employee savings schemes. So of course, we have, you said that already, but we have approximately 1 million employees that have chosen employee savings schemes invested in Fonds Solidaires. But we have to be aware that this 5 billion account for, or this 4 billion of employee savings schemes invested in Fonds Solidaires accounts for 4% of the total amount of employee savings scheme. So it's a progress, it's a success, but it's still a small part of the offer, of the choice of employees. So next slide, please. So this is to give you some information about the asset managers and the funds. So funds are pretty large. You see the largest fund is 400 million euros. Almost all asset managers are involved in this business, except the smallest one. And Ecofin Investissement is an investor which is reasonably important in that sector, especially because it offers a lot of Fonds Solidaires outside of employee savings schemes, and it is probably the leader if you look only at the part of the market which is outside of the employee savings scheme. And it's very interesting because if you offer such funds, you have to tackle liquidity issues because you have to keep always the rate of solidarity investments under the 10% cap. And if some investors want to get out of the fund, or if the 90% part of the investment falls, for instance, because of stock movements, you have to be able to buy back or to find a market maker to buy back these illiquid investments. So typically we have to organize the liquidity of illiquid investments with a bank. And for us, Ecofin Investissement, we organize that with our shareholder, which is a bank, Crédit Coopératif. Next slide, please. So what are the fields where we invest when we look at the part which is invested in social businesses? You see on the left side of the slide, on the top part, 41% is not directly invested, but is invested in investment companies that are themselves financing social businesses with very small size. But some part of the 10% pocket are directly invested in social businesses. So you see job creation, which accounts for 6%. Social housing, very social housing, not ordinary social housing, very social housing, 25%. Eco-friendly activities or renewable energies and so on, but usually participative renewable energies, 6%. Microfinance and development in emerging countries accounts for 10%, and some other topics are financed for approximately 11%. For instance, cultural activities, taking care of very old people, etc. What are the type of financial instruments that are used? Basically, equity is a large part of the pocket, 70%, and debt is only 28%. Actually, equity is not always joint stock equity. Most of these social businesses issue quasi-equity instruments. For instance, it's the case for charities, for non-profit organizations. So part of the equity is actually quasi-equity. What else can be said? The number of social businesses that are financed, of course, excluding the investment companies that collect money in order to lend it on to small social businesses, but directly finance social businesses. You have 185 companies that have been financed according to this overview that has been done by Finansol, which is an organization that studies these funds, but that has not all the funds in its field, because they analyze only the funds that get the label from Finansol. But it's a very representative part of the market. Next slide, please. Yes, 10%. The funds are called 90-10 funds, but if you look closely at the part of the funds that are invested, only 5.7% of the net asset value of the fund is invested in social businesses. So it represents 280 million euros. Why is this difference between 5.7 and 10%, which is a cap? Because usually the asset managers are very careful. They don't want to reach this 10% cap, which is a regulatory cap, so they keep part of the potential investment pocket in liquid assets. Nevertheless, these 280 million euros represent probably, let's say, 30 or 40% of the impact investment market in France. So it's really something very, very significant, and it was even more before the development of classical impact investment by private equity funds. So 10 years ago, probably it has been 60 or 70% of the investment of the impact investment market. So I have to add that usually these funds are managed according to socially responsible investment principles, because of course it's more consistent to offer to clients a fund where part of the investments are impact investments and the remaining part are socially responsible. Next slide. Yes, next slide is about the type of funds we have. Small companies are not able to offer a fund dedicated to the company itself. So we have what we call multi-entreprise, which is a fund which is dedicated to a number of different companies, and the large companies have their own 90/10 fund. So you see the difference in the amount which is invested in both and the number of funds. So you can observe that the number of funds is now approximately 100, which is a real ecosystem and which is one of the great successes of the market. So I have to conclude saying that, of course, we have this huge movement of 90/10 funds in the market, but we have in the same time some private equity funds dedicated to social businesses. Usually there is a difference between the two approaches. In the 90/10 funds, usually asset managers are not demanding huge returns on the pockets, the 10% pocket. They consider that the Solidarity Fund has to be let's say generous, or at least has to take into account the social objective of the company, so rates are usually low. In the pure private equity funds, private equity or private debt funds, usually investors are more demanding. They consider, even if they don't have a private equity classical return of let's say 15%, which is actually not even reached, but which is probably one of the things you promise when you raise money for a classical private equity fund. Even if they don't ask for 15%, they hope to get a return of, let's say, between 5 and 10%. In the 90/10 funds, the 10% pocket is close to 2% usually. Thank you very much.
Thank you very much, Pierre, for this overview. I think it's very interesting for everyone to put the 90/10 solidarity funds in the broader French context, because it really helps to understand where they come from. And when you said that they started technically not maybe in 65, but the French employee schemes started in almost 50 years ago, it's really interesting to understand. So thank you very much. After this concrete example of France, I think it's very interesting also to turn to Italy and to leave the floor here to Marco Ratti, who will explain an initiative that took place within the Banca Prossima to also allow some retail investments. Marco, the floor is yours.
Thank you, and hi everybody. I think we should maybe turn over the first slide, well actually the second, and the following one please. Alright, I'll be brief about this, but you really need to know a couple of things about Banca Prossima, which is the bank I work with, to understand what follows. The first point is the first arrow. We basically serve non-profits. So whereas we do allow for individuals to invest in social investment projects, we do require that the clients, as a matter of fact, the beneficiaries of finance, be non-profit organizations. So we get finance from individuals and organizations to organizations, which are typically our clients. And the other thing you probably need to know is that is the third arrow, in that Banca Prossima has developed an ad hoc rating system for non-profit entities. This, whereas it satisfies the usual paraphernalia of bank regulation, in particular, it is fully compliant with the rating system of our parent bank, which is Intesa Sanpaolo. We do have several characteristics of our rating system, which is tailored to non-profits. So we believe we can give a rating to our clients in a more precise way, and actually by this also kind of enlarge access to credit for non-profit clients. And this is what you really needed to know, and we can go to the next slide and introduce Terza Valore itself. Now, suppose that Elinor has a non-profit organization of sorts, and suppose it is a camp which caters for children which are ill, either long-term ill or badly ill, and they spend a couple of weeks on vacation, on free vacation on this camp. This is actually an existing example, something called Dynamo Camp in Italy. And she has this organization, and she needs to build a swimming pool, let's say. So what she does under Terza Valore is that she comes to Banca Prossima and says, look, I need to build the swimming pool, and I need money to do this, and basically I need debt money, I need credit to set up the swimming pool. So we examine the project, we rate Elinor's organization, and if we do like the project, we stand ready to finance up to 100% of it by lending all necessary funds at market rates. So if nobody else wants to finance it, we will, but we will do that at market rates. Then we make 2/3 of the total available, and the total can be up to about €1 million. The total loan is available to be taken up by people or organization that, let's start with lend to the NPO, to the non-profit organization, meaning that possibly Elinor has friends, family, she's got a good fundraising organization that contacts people. Maybe they cannot donate because they cannot give up the money, but they can lend the money and have it back at a future time. And Elinor can say that whereas we lend to her at, say, 3% for a 10-year project, she will accept lending by third parties, including individuals and organizations, but the rate should be up to whatever, 1.5%. And then we put the project on our platform, we open it for 1 month, and people are free to lend or in fact donate money to the project under this scheme. And they're also free to set the interest rate they want from 0 and up to the rate that Elinor has declared as the maximum acceptable rate. So, I mean, admittedly, in times of low interest rates, the advantage of this is possibly not immediately apparent. But when interest rates, especially for long-term projects, start to go into the 5, 6, 7% numbers, which is actually still fairly common for low-rated organizations, the opportunity to get finance at, let's say, 1.5% or lower is a significant reduction of cost. And the particular thing that we have, and we think basically nobody else has, is that the bank sort of guarantees the third parties which finance the project. Sort of guarantees means that there is no formal guarantee, but there is a mechanism by which the Elinor's organization is given a backup loan, and this backup loan is immediately activated upon default, and the proceeds from that are used to repay the third parties that have financed Elinor's organization. So basically, the risk that anybody who wants to finance Elinor's organization, the risk that they run is Banca Prossima risk, equivalent to Intesa Sanpaolo risk, so it's something like a BBB-, something like that, and not the risk of a non-profit organization borrowing money for 10 years, which is rather different. So To sum up how it works, please, let's go to the next slide. So what we do is we start the project, and when we start the project, it is actually a standard loan. We check, we perform the first phases as if it was a standard loan. We check the creditworthiness, we set up credit lines, we post the project on the platform, which can be reached at this address. Then we open up the platform for 1 month. At the end of 1 month, we decide how much has been raised via the platform, either donated or lent. We subtract that from the total, we lend the rest. Okay. We release all funds, our own and those contributed by the third parties, and we take care of all legal and tax aspects. There is a twist, loans between individuals, which is what this thing is from a legal viewpoint, are taxed at the personal marginal income tax rate, so it should go into your tax form. And what we do, we cannot pay it directly, but we can set up all the necessary documentation, which is quite useful for the individuals. Let me also say that this thing, since Italians really hate to have things to put in their tax forms, it is a powerful incentive to lend at zero, because at that point there is no gain that people are making from their loans, nothing to be taxed, nothing to be put in a tax form. And as a matter of fact, as we shall see, most of the lending under Terzo Valore is actually done at zero. So what does the client, Eleanor, what does she do? She carries the project to the bank. She provides all the publishable documents. Publishable means that they are going onto the Terzo Valore portal, visible to everybody. She promotes fundraising amongst its supporters, because most of the third-party money is actually raised through the activity of the non-profit organizations which access the portal, as opposed to it just materializes after it is published on the site. And of course, it reports the progress of the financed project once the project it is actually financed and the swimming pool is actually built. So next slide, please. The advantages are basically the ones you can see in bold. The cost is made sustainable by lowering significantly the interest rate. I mean, bear in mind that some of the funds may actually be donated, and the part that is donated can be seen as something like a loan at an interest rate which is minus 100%. So if you count things that way, the reduction of cost is really very significant. For some projects, there has been a significant donation component. Terzo Valore is basically a social lending platform, so it's mostly for debt. But in some projects, donation was sufficiently high that the total cost of credit was very significantly reduced. Is because the Terzo Valore portal automates payments, so basically third parties give their money to Banca Prossima, and Banca Prossima releases all funds simultaneously. And of course support. Banca Prossima provides consultancy and general support, and we plan to expand on these services. Now let's go to the next slide, please. This is some instances. I won't go into them very deeply, but these stories can sort of help these things to get better known. The first instance is a foundation that owns a part of an Italian city called Como. They basically have space, meaning some accommodation, but especially a school for challenged children. And especially when these children leave the public programs, which have a maximum age of 18 years, then basically the youngsters are abandoned to themselves. But they get an education in the school. It's mostly a technical education, and they live there for a while. And they needed to basically refurbish the spaces, and they raised 900,000 euro, which was the limit of Terzo Valore at the time. Now we can sort of exceed that limit somewhat if we want. 2/3 of that were lent via Presto Bene, which is the lending part of the scheme, and the remaining 300,000 were supplied by us at market rates. Same thing for the parrocchia. Parrocchia means parish. This is a parish in a village near Turin. They wanted to build something which in northern Italy is very common. It's called an oratory. It's a place where youngsters meet, play football mostly, and practice other activities. They do their homework and etc. And they are not particularly compelled to do something strictly religious there. It's mostly a social gathering scheme. They had to rebuild their oratory, and they also raised 900,000, but the novelty for that was that the participating families actually donated 360,000 euro through this scheme, which was very popular in the parish. There has been another parish doing something like that recently, and it was nice to see actually some of the parishes going around with their PCs and helping people out, lending and donating some of their money through the system. Let me just skip the last one, the ANFAS, and go to the next slide to give you some idea of the numbers we did. The portal has been operational for a while. It's about 6 years now. We have some dozen posted projects, 70 at the moment. This slide was done. Which is not very long ago. There are not very many. There are not very many more now. It's mostly in social and health care, but there is some other things. I look closely at the cultural sector, and there are some instances for that. The average amount is over 50,000 euro. The total value of the projects which were posted is in excess of 15 million, of which we loaned from third parties about 6 million, and there was a significant 1 million donation. You can see the number of lenders and benefactors. Lenders are, of course, those doing social lending, and benefactors are those donating. There is an estimate of the interest charges saved by the clients over the loan's duration. So this is, if a loan is 10 years, has 10 years maturity, we sort of multiply by 10 our annual estimate. And the nice thing is that there is quite a lot of money. It's about half it's almost half the total amount lent by third parties, which was received at zero by several social lenders. And this is true for this is massively true for the parishes in which parishioners basically lend at zero. Also, some of the lending is actually transformed into donation. Fondazione Cometa, the first example in the last slide, does something which I find clever. When they pay out one installment on their loan, they typically send a letter about 1 week before paying, saying to all their lenders, look, this is the installment of your loan, thank you very much, and if you would consider to actually donate that amount, our IBAN code is the following, and you can actually donate it. We'll be very grateful for that. So that's it. I think I described what I wanted. I hope I was on time. Yeah. And I'll be happy to take questions. Thank you.
Thank you very much, Marco. If I had a social enterprise or non-profit organization in Italy, I would definitely look at Terzo Valore. So thank you for that case study with me. I thought that was very nice. Yeah, it's a very good example of retail funding, and also of combining grant money and then more investment money in the loan form. But really interesting. I think maybe I can take this quick interruption to remind our participants to write their questions in the box in the panel control. We have received already a couple, and we will make sure that we answer to these at the end of the session. And to conclude this tour d'Europe of retail social investment, let us come back now to Camilla, who will give us an overview of this market and the different mechanisms that are taking place in the UK. So Camilla, the floor is yours again.
Thank you. Perfect. And actually we can move to the next slide, please. Great. So just to give a sense, I think, of the scale and momentum around sort of retail social investment in the UK, some research that came out last year sort of suggests that actually the amount that's saved and invested positively grew by about 11% between 2014 and 2015. We're looking at around £3.6 billion that's been saved or invested positively by ordinary people across the UK, so that is a significant amount. And actually, just to put that into context, that rate of growth is more than 4 times higher than we've seen the sort of growth rate of general UK household savings and investment over the last 5 years. So I think that momentum is substantial. So in terms of the numbers of individuals, we're looking at around 1.85 million people who are in some way using their money in a positive way to generate impact as well as hopefully financial return. And that equates to around 3% of the UK population. And I think those numbers are hugely sort of exciting, and it's great that we're seeing that sort of fast rate of growth. But actually, I think coming from 3%, I think there's huge potential for us to grow that number even further. If you move to the next slide, please. Okay, so if you are an ordinary person looking to save or invest your money in a more positive way, what are some of the ways in which you can currently do that in the UK context? So first of all, on the savings side, there's a small but I think a growing number of social savings products in the UK, and most of those are available from one of the 3 largest social banks in the UK. You can see on the slide there. And we estimate that about 55,000 individuals in the UK are doing some sort of social or positive saving at the moment. And looking now to investment opportunities, I think probably one of the most accessible ways for ordinary people to invest in sort of social causes is through a type of product known as community shares, and I'll talk about them in a little bit more detail on the next slide. But essentially, this sort of mode of investment allows local people to invest in community businesses and also to have a say in how they're run and to make sure that they're creating benefit and impact for local people. And we've seen more than 60,000 individuals that have supported communities largely, supported organisations largely in their communities through this form of investment. And it's often in reasonably sort of small denominations, small amounts of investment, can be anything from a few £100s upwards to that point. So a really accessible product there. I think for an investor that's potentially got more capital to invest, one of the ways in which they might look to do that is through a product which I talked about earlier, a retail charity bond. So for example, Golden Lane Housing used that bond to get an unsecured loan finance to grow their impact. And we think that market is currently worth about £86 million in the UK, and we're seeing more charities that are using this mechanism to raise investment from retail investors. We're also seeing a growing number of positive investment funds. I think it's important to make the distinction here from sort of negatively screened funds. These investment funds actually invest specifically to generate positive social or environmental impact. They also tend to be much more transparent in terms of what they invest in and in terms of how they talk about and report on their impact. And again, there's a few examples there on the slide. So the Threadneedle UK Social Bond Fund, and that's a fund that can invest up to 10% into charity bonds in the UK, but there are many others, and we think this is an area that's going to continue to grow in the future. And another option for individuals is to use the social investment tax relief. And Big Society Capital worked with the UK government to develop this tax relief that was launched in April 2014. And this relief allows individuals to get a 30% tax break when they make an investment into certain types of charities and social enterprises. And this tax relief can be used both to make direct investments. So, for example, it can be used through the mechanism of community shares. But there's also a growing number of funds that individuals can make SITR investments through also. And then on to platforms, and I've mentioned, I think, in the sort of broader context of this really significant growth that we're seeing in the UK and elsewhere of peer-to-peer and crowdfunding platforms. And some recent research that was released by Nesta in the UK, I think shows that this market is now worth more than £3 billion just in the last year in the UK alone, and that's both loans, donations and investment that's being made through different types of platforms. But actually where the sort of interesting opportunity, I think, is that crowdfunding at the moment actually accounts for less than 1% of the giving, the money that's sort of donated or lent to charities or social enterprises in the UK. So again, there's huge potential there, I think, for organisations to connect to ordinary people and ordinary investors through those platforms. And I think the other thing that's interesting to point out here is we're starting to see the evolution of a secondary market, secondary trading market for certain types of social investment, and that's being driven largely by an organisation called FX. And FX is a retail social investment platform in the UK, and they connect individual investors to a whole spectrum of different types of savings and investment opportunities, many of which are sort of mentioned on this slide. And FX are actively developing this sort of secondary trading market for specific types of social investment, and that's one way of perhaps introducing some liquidity into the market for these types of investments, again with the view of encouraging more people to save and invest this way. Next slide, please. So thinking about where we're seeing the fastest rate of growth in the market, that is in direct forms of investment. So as that's sort of defined here, when we talk about direct investment, we're effectively talking about 4 types of products or channels. So that's community shares, which we've already mentioned, charity bonds again, also bonds and shares that are issued by companies with a clear sort of social or environmental benefit. That's sort of what makes up the landscape of direct positive investment. And I just wanted to touch again on community shares. This is an area where we have seen significant growth, and as I mentioned, it is an area that really allows local people to connect to local organisations and have a say in how they are run through this this share type of investment. And we're seeing lots of interesting, the emergence of lots of different types of models. So community ownership of things like pubs, local shops, sports grounds, community energy schemes. These are the types of organisations that are actually tapping into people that live in the local area, drumming up support and actually raising investment capital to deliver the benefit and they're generating in their communities. An example you can see on the slide is a community-run and owned shop in the northeast in England, and we're seeing more and more organisations. It's currently about 400 that have used this model as a way of connecting to ordinary investors. Next slide, please. So just to round off, and I think looking ahead, particularly at a number of the projects that we're working on at Big Society Capital in partnership with others to try and really tap into this momentum and grow the retail social investment market further. And there are three areas I just wanted to touch on here. The first is around products. So I think what we would really love to see are more products that are suitable for retail and ordinary investors. And we're actively working in partnership with the Cabinet Office and other organisations in the UK to try and catalyse the development of more suitable products. And one area that we are sort of specifically looking at in a lot of detail is around whether we can get a social pension option developed in the UK. So based on a similar model to the 90-10 funds in France, we are looking at whether a similar scheme could be offered by corporate employers through their defined contribution pension schemes. So we're actively trying to sort of catalyse that product coming through into the market. So now looking at platforms, we very recently launched the Crowd Match Fund. And this is a £5 million match fund to match crowd-funded investments made by individuals into organisations that are eligible for the social investment tax relief. So again, I think we see this as an area that is going to sort of grow in the future, and we're looking at ways of actively supporting more charities and social enterprises to use this channel as a way of connecting with ordinary investors. And finally, on the people point, I think this really speaks to demand and getting a better understanding of what does individuals' demand look like to do more social investment in the future, what type of products do we think they might be interested in, what might motivate them to do more of this in the future. And we're working with Ethics and IFF, and they are doing a piece of research on behalf of the Social Investment Research Council in the UK to really get under the skin of this. And this is a quantitative survey to more than 100,000 sort of active and potential social investors in the UK. And we're hoping that findings will be available at some point in the autumn. And this will really help us, I think, have a much clearer understanding of what people's motivations might be in this area to help drive this sort of forward. And just a final word from me. As I said earlier, this is something that we are hugely excited about, and we're actively looking for others who are interested in growing this retail social investment landscape. So I would please absolutely extend a very sort of warm invitation for people to reach out to myself or my colleague Simon Rowell or others at Big Society Capital, because lots of us are working in this space. So please do reach out for more information or just to have broader conversations about what we can learn from each other here. So that's all from me. Thank you.
Thank you very much, Camilla, for this very comprehensive overview of what's going on in the UK. As we all know, it's a very dynamic market, and even though it's not big in numbers yet, representing a couple of % of the population somehow, but it's indeed very promising. And I know that many countries are also looking at the different products that exist in England to see whether they could be implemented in other countries. So that's very, very interesting. It's great because it leaves us about 20 minutes, a bit less than 20 minutes for Q&A and panel discussion. I have received a couple of questions from our participants. Maybe, I don't know, Camilla, whether you have already some questions for our two other speakers, or whether I should look at the questions for our participants, as you prefer.
I mean, thank you. I do have one question, and this comes specifically from thinking about our aim to develop a social pensions product in the UK. So, Pierre, this question is for you. Mm-hmm. I'm just interested to get a better understanding of the way the 90-10 funds work in France and the extent to which individuals are placing what is effectively money for their retirement through these schemes. Because one of the, I guess, the challenges that we are thinking about in the UK when developing a similar type of product is that actually when we were talking about the money that people use for their retirement, it's potentially a sort of sensitive topic, thinking about different ways in which that could be invested. So I'm just keen to understand a little bit more about the extent to which people use this mechanism for retirement savings versus just general longer-term savings.
Yeah, that's a very good question. And just if I can complement on to Camilla's question, I think from the feedback we hear about 90/10 funds, sometimes we hear that there is some sort of a misunderstanding between these solidarity or employee saving schemes and then pension funds. So it's a very good question, and thank you for raising it.
There are different categories of employee saving schemes, but most of the employee saving schemes are not pension funds. They are funds that have to be kept at least 5 years in order to get the tax relief. So basically every year you get money due to the sharing of profit. You can add some money to the fund if you want to save from yourself, and you keep this money 5 years at least, except if you remove, if you get married, if you have a child, there are some exceptions, but basically you keep this money 5 years. But since this money is tax-free and the income linked to the savings is tax-free, usually people keep the money very long time. And even when they retire, sometimes they keep the money because as retirees they can have the same advantage. So it's not something which can be completely compared to a pension fund. It's more long-term saving, which is usually used after 5 years, because after 5 years you have nothing to justify to withdraw your money. If you so you can use it as you want, and usually people keep it at least until they retire.
That's also, if I may, complementing also there's a question just from one of our participants that's very much related to this. Robert Hewitt is asking, how do the individual investors in the French model view the purpose of their employee savings investment, like a pension, or less vital for future income? And I think you just gave a bit of information about the difference between the two models. So, that's,
yes.
That's very
most of the employee saving schemes, there are two categories, but most of the amount is something which doesn't give a right to an annuity. You take the money when you want after a certain time, so it's not something. It's not a revenue. It's a saving. You can withdraw.
Actually, there's quite a few questions coming up now in the box here. So maybe I can ask one. I have two questions for Camilla. One also for Marco. Camilla, I have a question from Ulrike asking if you have, in your overview of different retail investing models, if you know about any possibilities in Germany, in the case of Germany. Have you heard of any concrete examples there or opportunities? And then a second question is, you know, you refer to the secondary market in the UK, I think with ethics. Are there any other examples of secondary market developments in other markets? That's a question from Vivian.
Okay, so to take both of those in turn, I have to say when we did the scan of different models in European markets, we didn't come across anything in Germany. And that's absolutely not to say that something doesn't exist, and we just didn't find it. So I would say, just to call out again to anybody out there who's aware of activity in other markets, we didn't find anything, but that doesn't mean that it doesn't exist. So please let us know if people are aware of that, and if anyone on the call also is aware of that, please shout out. On the secondary market, so I have to say we haven't looked in depth at secondary markets for social investment type products across other parts of Europe. I think it's fair to say that the work that FX are doing in the UK is pretty unique. I think secondary markets exist in other forms of sort of crowdfunding or peer-to-peer loans. There are a couple of other platforms that I know of that allow sort of secondary market trading of those types of products. But certainly in terms of social investment, I believe sort of FX are driving the secondary market in the UK. And again, I have to say, to be honest, I'm not aware of this happening in other markets. Probably it depends on the type of product that we're talking about. If we move probably more into the I guess sort of ethical type products, so ethical bonds, I'm sure there'll be secondary market activity around there. But as I say, for specifically what we would describe as social investment type products, I'm not aware of anything similar in Europe. But again, others may be, so please shout out if you are.
And we will also keep an eye on it. Yeah, Pierre?
In France, of course, there is this 90-10 system. So you have to keep your amount of social investments under the cap of 10%. So in order to be always able to keep it under 10%, you can need a market maker if of course the other investments fall, or if people want their money back from the fund. So we organized, probably Crédit Coopérative is the only one to do so, but we organized a kind of market making, but it's not a market for any circumstances. It's only if you have really a need for liquidity. For instance, if you reach the 10% cap. And of course, when the bank does a business of investment bank, when it tries to place a bond issued by a charity, for instance, in different funds, it offers a market making facility, which is very useful because it helps the fund to get an external pricing every week or every day for the non-liquid assets.
Thank you. I also have a question here from Norma. Norma, I think your question is directed to Marco. Norma is wondering what is happening if and when a social business fails to repay the loan on the platform. And I have maybe a second question to ask you, Marco, is are there any non-Italian non-profits that are applying for to get money from Terzo Valore?
Right. Sorry, I'm just taking notes. Defaults. What? I'll answer the questions and then maybe give some comments on the foregoing questions and answers.
Yeah.
When a non-profit default, it has never happened. But the theory of what happens if a non-profit defaults on Terzo Valore is that we then activate the backup credit line. So we basically lend to them the entire amount that they have defaulted on. This comes available in their current accounts and is used to pay back the third parties that have financed the organization. So it's a form of it's a sort of guarantee by backup process essentially, and this is rather unique because we thought when we created Terzo Valore, this was a while ago actually, that a weak point in social lending was that banks exist for a reason basically, which is supposed to be, or one reason is supposed to be that they monitor more effectively the people that ask for loans more effectively than single individuals giving them money. So and this we think we actually do that better than individuals may. And so having the guarantee, the effective guarantee of a bank backing the loan that people make is a sort of insurance policy against, defaults, basically, in the future by non-profit organizations taking out loans, which, sometimes or other is basically about to happen. We don't know of any default crisis in crowdfunding schemes, in social lending schemes, but we think that sometimes or other it's going to happen anyway. So this is quite important to us. Non-Italian organizations, we would actually like that to happen. At the moment, the platform is quite insular to Italy, frankly. Insular to Italy means, for example, that the tax consequences of lending money to an organization are handled efficiently by us if the lender is Italian and the organization taking the money, so the borrower is also Italian. We are actually looking for partnerships abroad, not least in the UK, and we would be actually very happy to partner with anybody looking to sort of replicate or enhance or do anything they want, basically, with our own assistance on their own territory. So the answer is not at the moment, but we would be very happy to see it happen in the future, and we'll collaborate on that, and we'll also not be particularly venal in our handling of this.
Okay.
In terms of the debate going on beforehand, and particularly the issue, are there schemes existing in Germany or in other European countries, I think crowdfunding platforms exist basically by the dozen in every country. They tend to be very small on average, but they do exist, and it's very difficult. I know the Italian numbers. The Italian numbers is there are dozens, literally, of crowdfunding platforms. Most of the platforms are either donation or reward based. The crowdfunding has basically four types: pure donation, reward, which means donation and then I'll present you with something, social lending, and equity based. And in most continental European countries, at least, equity is an issue, certainly with non-profits. Other social economy organizations may issue equity, but non-profits are a problem. And most of the money is in social lending platforms. So I think if you drill deep into any country, you'll probably find the crowdfunding schemes. The issue is how much they actually lend. Also, there are social bond schemes of various kinds. In Italy, basically, there have been two kinds of issues of social bonds at fairly low interest rates, below market interest rates, which were meant to finance banks, including us, who would then finance social businesses by lowering their interest rates by the same amount, by the same discount below market that the issue was made. Okay, so if, let's say, the market for 5-year bonds issued by us means that they should be issued at like 3%, we rather issue them at 1%, and we then rebate the 2% on our credit condition. That's a story. And this happens this is one type of social bonds existing in Italy. The other type is much more massive, but they are not directed to finance social businesses. They are rather directed to take a small percentage of the issue, like 0.15%, something like that, and donate that. So the bank gives up its placement fees, and donates them, basically. That's the other thing that goes on, and of course retail investors can invest in that too.
We're getting to the end of this session. There is a couple of other questions for you, Camilla. I don't know if, because one would deserve an entire webinar technically, but another one is about here there is a Danny that is representing a social crowdfunder in the Netherlands, and she's asking, or is asking, that they're mainly in the retail product, and they're wondering from your experience if they would enter the UK market, they should primarily focus on the retail market or target more institutional aspects as well from the start. So that's one question, if you can give a brief answer to that one. And then the million-dollar question is this one, which policy changes in the UK could allow for social investment? What are the lessons learned for overseas markets? So that's really broad questions, and then I will conclude after your answers.
Gosh, you may have to remind me of the first question.
Yeah, the first question is crowdfunding, a crowdfunding platform in the Netherlands that is willing to enter the UK market, and where should they try to position themselves, more in the institutional part of the market or the retail part of the market? That's how it's raised. If you don't understand very well, maybe we can put you in touch directly with Danny afterwards.
Yes, that might be the best option there.
Okay.
Just on the policy question, I think you're right. This could take up an entire webinar on its own, but just a couple of areas I think where sort of big society capital are specifically focused, where we could see policy playing a greater role. Now I would say we've seen some interesting engagement and policy interest in two types of products specifically. So first of all, the social pension option, and also the potential for sort of social ISA type products. And one of the areas we're looking at is whether, would it be sort of feasible and desirable for the government to play a role, perhaps in introducing some legislation similar to the legislation that catalyzed the sort of uptake of the 90-10 funds in France, whereby corporates were actually mandated to provide this 90-10 fund as one option. And I would say that we're actually just about to start a piece of work looking in more depth at what some of the policy levers could be to help us sort of catalyze that further. I mean, as I said, the policy discussion is something that we're looking at, and probably could take up a full other webinar. So no, I would say, yeah, please, come back to us, and if you could connect me to that question on crowdfunding.
Danny, absolutely, I will do that. Thank you very much for your answers to all our speakers. Actually, Pierre, Marco, and Camila, it's really great. I think it's 4:31 p.m. Brussels time, so it's really the right time to close this session. If you do have questions, any questions about our policy work, you can reach us here at EBPA. Myself, Simon, or Lisa, who is also a policy advisor, now working at ESADE. We would like to also kindly thank our supporters, the BMW Foundation, the Omidyar Network, and of course the European Commission. And then one last announcement here, our annual conference of 2016 is now open for registration. So this year we'll meet in Paris on the 3rd and 4th of November, so you can have a look at our website and register. Also, as I mentioned at the beginning of the session, the recording and presentation of today's webinar will be made available on our website probably in the course of next week. We might have lost a couple of minutes at the beginning, but 95% of this session will be online, so it's great. And we'll probably have another session in our EU webinar series in the course of September. So stay tuned. And again, thank you very much for all our speakers today.